Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com tells us we did not see new market highs this week and what we can expect from that. He also takes a look at gold and oil. InkResearch.ca CEO Ted Dixon comments on what insiders are doing in a number of sectors, especially with tax loss selling season underway. Editor of the popular blog Juggling Dynamite, Danielle Park, talks about nearly half of Canadians believing they will run out of money during their retirement, and Ontario's very costly move to shut down 750 sustainable energy projects. Plus, at the end of the show, we'll have company showcase updates from American Manganese President Larry Reaugh and from Cypress Development's Don Mosher. We'll talk to Ross Clark right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
Good to be with you, Jim, and an interesting week.
And for people who are longtime listeners, you have a special deal in place right now for people interested in charts and markets.
Yeah, that's right. We have a special $60 trial subscription that will give you all of our reports from now through the end of the year. And so that includes my technical analysis as ChartWorks, Bob's Hoy's weekly pivotal events, which basically touches on all of the markets that we follow, and then his editorial comments, which can be enlightening as well. So if people drop by the website there on the front page, chartsandmarkets.com, there's a trial subscription page there.
And as you said, interesting in the markets this week in that for the first time in a long time, we didn't set any all-time highs.
No. I mean, we actually have a down week in a number of the indices, a bit of a pause here. And we've been pretty much in need of having one of these. There's no question that the market was getting a little bit ahead of itself. Our momentum oscillators actually turned a little bit negative here on Wednesday, and we've also seen some changes in the VIX, which is the measurement of volatility in the market. That's expanded just a little bit, but enough to serve as a bit of a warning. Wouldn't be at all surprised if in the next week or so we came back and tested the breakout level that we had here about 10 days ago, and still thinking that as we move through towards the end of the year, that classic year-end rally, sort of out of the second, third week of December into early January, that's still a very distinct possibility. And we'll look for some larger changes in momentum after that, because both the decennial pattern, which at the end of the ninth year, beginning of the 0 year in the decade, historically has been a tough spot for the market, with corrections into February. And also, we take a look at the presidential cycle. Going into an election year tends to be fairly choppy in the first half of the year, not having the classic upside bias into April, May. More of two waves of selling with an interim rally between.
Gold, how's it doing right now?
Well, it was back at the end of September. The Commitment of Traders data, so that's from the CFTC, the Commodity Futures Trading Commission. That breaks down the positions of the speculators, the commercials, and then refines it down to more refined ones. But we tend to look at the two major numbers there, and the positions of the speculators were up to all-time highs early September, came back at the end of September and made marginally higher highs, while the commercials were making marginally greater short positions. But the momentum of the movement there was important. The relative strength indexes became extreme, and we've seen a bit of now with prices pulling back, we're seeing there's been a small reduction in the open interests in the number of positions of the specs and the commercials, but not enough, we think, to be of big significance. You typically want to see a good clean out, and there are 5 times historically that we've seen this type of an overbought situation and a rollover. And in each one of those instances, the relative strength index on the commitment of traders numbers, so this is sort of a derivative of a derivative idea, once that comes back beyond normal, beyond a neutral level, that's where you can get a more pronounced rally on the upside. So since we got the sell signal there at the end of September, prices broke. The 20 and the 50-day moving averages crossed over into a negative position, and 2 weeks ago, we got really good oversold readings. And the early part of this week, prices rallied back to create the first overbought reading on a daily chart. And the first overbought, once you've rolled over, is a classic selling opportunity. So up into that 1478, 1480-ish range on gold became a pretty big overhead resistance. It's also close to where the moving averages were. And at closing off the week at 1463, it looks as though it could be primed for the deeper break.
Crude seems to be doing quite well, considering usually this time of year it's on a slide downwards.
Well, yeah, you tend to have weakness around the end of the year, first quarter. I continue to just sit with my model on that 10-year cycle, which in the 9th year of the decades has had a push to the upside from a good oversold reading in the early part of the second half of the year, sort of in July through September. You find a good oversold. We had it at $52. You get a really good bounce out of there. We're at 58 and change to close off this week. The norm here on this rally would be that we would rally up to about $62. We've got a moving average band, and it's right up there at that level. We would also be looking for the relative strength index to produce an overbought reading. And if we can push up through 60, that'll be enough to get the RSI into selling territory, and we'll be maybe looking for that kiss of 62. And from there, look for a setback. And depending upon how quickly the high happens when we start to sell off, that could have a pretty good impact on the downside in some of these oil and gas stocks, because they've had a pretty rough year of it. Tax selling pressure at this point now, at the end of the third week of November, should really be starting to pick up as we go into December. So positions that are offside, people look to take positions off there, because if they want to take a profit on some of their other stocks that have been making all-time highs, they want to make sure they've got a net zero as far as their taxable gains are concerned.
And Ross, once again, your special till the end of the year?
$60, and that's at chartsandmarkets.com.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, what are the insiders thinking? We'll find out from Ted Dixon.
Always consult your investment professional before making any investment decision.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Ted Dixon, CEO and co-founder of IncResearch.ca. He invented the Inc. Canadian Insider Index, which is used by the Horizons Canadian Insider Index ETF, 2017 and 2018 Fund Data Fund Grade A Plus award winner. His website, CanadianInsider.com. Welcome back to the show, Ted.
Jim, it's a pleasure to be back on This Week in Money.
Ted, how is the new year going to shape up when it comes to inflation?
Well, this is a theme that we've tackled in our newsletter that we put out to Canadian Insider readers on November 20th. You can go to our website and take a look at it for free. It's in our market center. And the title is, Will Inflation Be a Top 2020 Surprise? Now, where are we coming from, or where are we getting this idea about inflation, Jim? Well, basically, it started with what we saw going on in the oil patch with a lot of insider buying in that area and sentiment being pretty high, which followed quite a bit of insider activity in the basic materials area, mining area, which really kind of led the move. And it got us thinking, well, what is going to turn the fortunes around for these beaten up resource areas? We've been thinking about this for some time. And it comes down to really, do we get some nominal growth, some nominal inflation into the system where we start seeing commodity prices rise? Okay? So if we don't have, if we stay in this kind of downtrend or trendless commodity environment that we really had since 2011, it's going to be really hard for resource stocks to go anywhere, okay? But insiders are giving us a signal, very high levels, that they're positioned for a change. And the only change I think that, that can come about really, that's going to lift the boats here is going to be inflation. And so what is the case for inflation? Well, there's been lots of headlines, lots of stories about inflation being dead, that there is no more inflation. But, really, that's not true. I mean, there's just not as much inflation as some people, central banks would like. Last time I checked, there was still quite a bit of inflation, even in the United States. It just wasn't quite at the Federal Reserve's magical 2% a year target. It's kind of somewhere, take your pick, where you're looking at their target. Their gauge, this PCE, it's about 1.5%. 1.7%. It's somewhere around there, okay? So no, it hasn't sustainably got to 2%. Okay, so why is that important? Well, because these central banks, including Bank of Canada, Federal Reserve, Bank of Japan, ECB, they've been hitting the wrong targets. They've been generating inflation. It's just, unfortunately, it's all been in the stock market and in real estate, but that's not their job. Their job is to generate consumer price inflation at 2%. Okay, that's their job, not my job, like in terms of telling them what to do. I mean, that's their self-imposed rules, okay? They're rules-based objectives that they want to get 2% consumer price inflation. Whether that's a good policy or not, it's a completely different matter, and we're not going to talk about that. We're going to talk about investment context, about central banks. Have they finally stumbled onto the right formula to get 2% consumer price inflation, which will finally lift the commodity boats? And we believe that Jerome Powell may have stumbled across the magic formula. And what is that? Well, they're doing asset purchases, and they're not buying bonds. They're buying treasury bills, and those are short-term government-issued securities, typically less than 1 year maturity, and that is a lot more commodity-friendly than buying long-term bonds. And why is that? Because it keeps rates at the low end down, and that favors short-term assets. Treasury bills, but also commodities. You don't tend to hold commodities as a speculator or even, on a business level for more than a year. Like you're putting them in inventory, you're hoping to use them, you're hoping somebody will come and buy them, but you're not buying copper to store it in your warehouse for 40 years or 20 years, okay? It's not like the Austrian, 99-year bond or 100-year bond, okay? So what the Fed is doing is very commodity positive, Now, the initial reaction to the market has been, oh, this is QE all over again, and this is going to be great for stocks. Well, yes and no. We think it is going to be good for stocks, but it's going to be good for Canadian stocks. And in fact, since the Fed started its bill buying one, we call it. Some people call it QE4. I don't like to call it QE because it's different than QE. Actually, the Canadian Insider Index, which is a mid-cap oriented Canadian index, stocks that are favored by insiders, it's one of the best performing indices in North America, okay? So you're starting to see Canadian stocks do quite well. So, for example, as of November 15th, which is about the 1 month mark of this new program that the Fed started to generate in terms of money printing with its bill purchases, the Canadian Insider Index is up 5.5%. That's even better than the Nasdaq, which is still on a lot of speculators' radar screens as a go-to moneymaker. That was up 5%. So Canadian stocks are about to enter, or finally, and I say finally, a phase where they should do well. And in fact, we would suggest, and this is not just our idea, and in fact, I have to give a credit to a fellow that is from the United States, Keith McCulloch from Hedgeye Risk Management, who actually who actually put it all together for us. He gave an interview on In Culture Money, and I think he kind of knocked it out of the park. He said this is shaping up to be a lot like the end of 2007, where the U.S. started to slow, but Canada, was on a different path, and Canada was still growing. There was a divergence. It wasn't permanent by any stretch. It was for like a year or less than a year actually, where the U.S. started to slow. Nobody knew it at the time, or very few people knew it. You could still turn on business televisions and networks, and you'd hear about how great the economy is and how everything's contained and la-di-da. But in fact, the U.S. is entering recession. But what happened after Q4 2007, as the Fed was starting to get loose, commodities started to roar, and oil, I believe, within 6 months was soaring well over $100. So are we going to hit $100 oil again? I don't know. I wouldn't make that prediction. Probably not. However, when you look at what's happening with insiders in the oil patch, when you look at how people are positioned in oil patch stocks, believing that the world is awash with oil, that oil's more likely to go down to $35 than ever hit $75 again, that everyone's talking about how electric vehicles is making oil obsolete. That does not in itself position oil for a turnaround, but what it means is if oil does turn around, most investors aren't prepared for it and will have to scramble, and you could see a real move, a real surge to the upside if oil starts to break out. And we did see some positive action this week. It doesn't mean we're there yet, but basically oil sold off really hard midweek on news that Russia didn't want to, or rumors really that Russia wasn't going to do any more cuts or cut deeper. I'm not even quite sure what the story was. And, the algo sent oil tumbling. But the next day it bounced right back, even when the inventory data wasn't so hot. So maybe oil is finding a foundation here. It's a seasonally weak period for oil. So, the message I want to leave with your listeners is that be prepared. And now we're entering, a nice tax loss selling season where you're going to see a lot of oil patch stocks still under weakness. Now might be a good time. If you don't have any exposure to the oil patch, now might be a good time to start having at least a little bit of exposure. If you're into equities, if you are an equity investor and you do have any degree of risk tolerance, there is a risk that we could see inflation and oil come back in the new year. And if the market is handing you all these oil and gas stocks at very low valuations, in some cases with astronomical yields, and that are generating, free cash flow or are very close to free cash flow, or would be very free cash flow positive if oil went up even $10, then, you've got the makings of a potential big opportunity coming up here over the next month. But again, we would say that, chances of this scenario unfolding, like a 2007, 2008 scenario, last bit of 2007 up until mid 2008. Then then we're into a whole different ballgame after that. But I would put it around 33%. So it's not a sure thing, but it's big enough where if you're taking a diversified approach to your portfolio, it's not an area you probably want to have avoided. And I imagine there's a few number of people out there who haven't really given oil and gas a big thought. They thought, well, that oil is dead. They've heard about this over and over again. At the very least, I would recommend that people challenge that assumption and revisit it. And if you think oil is dead, if you think it's in a cyclical and secular downtrend, then this trade is not for you. But if you believe there's a good chance that oil at least has one more last hurrah here before electric vehicles take over the world, then that may be something you want to consider as we head towards Christmas.
We'll have more with Ted Dixon when This Week in Money returns.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Ted Dixon. Ted, with tax loss selling season upon us, what are insiders doing, for example, in the mining sector?
Well, there's kind of two worlds in the mining sector. There's the gold world, and then there's everything else. And there isn't a lot of tax loss selling in the gold group amongst good gold companies because they've all gone up this year. All the good ones, for the most part. There's always some exceptions. So we have not seen a lot of, I would call, tax loss selling opportunities in the gold mining sector. You do see, though, opportunistic situations where there are pullbacks based off of whatever, so news comes out and the production wasn't as much as people thought, or the resource estimate. You got to sell the news fact. So it's always good to keep an eye on what insiders are doing in the gold area in terms of when they identify mispricing in the market. And now, what do I mean by that? That sounds fairly academic, but if a stock moves, and we've done a couple of morning reports trying to provide examples of this. If the stock moves either up or down on news, okay, so it moves up on news, it's good news. What are insiders doing? If they're still buying that news, that means the market is still slow in reacting to that news. So, we have seen some gold companies that are going up and insiders are still buying. Those are rare, but we are seeing one or two. More often than not, it's when stocks go down that investors panic or take some profits on news. You want to see, are the insiders coming in and buying? And because that's saying, no, the market's overreacted to this news, and this is a buying opportunity. So, those come across, but those are opportunistic. So we're not seeing widespread buying at this point based off of tax reasons for the most part. The industrial metals area, copper, for example, that's another story. We are seeing a number of stocks that have been beaten down and really need this inflation story that we talked about before the break to get going. So we have seen some copper plays and zinc plays with some insider buying. It's a more contrarian approach or opportunity. So you really have to like the story, and you also have to believe that we're going to get a bounce here in inflation. If you think we're heading for deflation, some kind of huge credit event that's going to, if you think that it's only a matter of time before the banking system blows up, then industrial commodities are probably not the place for you.
Marijuana sales were down 33% in Canada in the third quarter. Is this a case of governments just not being able to sell drugs and make money? Is it overpriced, overtaxed, and poor quality? What has happened in that sector?
Well, I probably have got more emails and more questions about should I be buying marijuana stocks now during tax loss selling season? Because, they've been beaten up so much and they are going to face these tax loss selling headwinds. But, there's very few that actually come across our radar screen yet as being attractive based off of our criteria. And our criteria, we look at valuations, we look at the insider commitment of a company, and we look at price momentum. So we're just not seeing the value there yet, and the insider buying combined to make up for the lousy price momentum. There are one or two exceptions, but the couple that we've written about, one in particular is doing all right. So there won't be a lot of tax loss selling in that. I'm not going to mention the name on air, unfortunately, but let's just say that they're benefiting from the fact that all these growers have too much product that they can't get through the retail sector, these problems that you just mentioned, Jim. So, I think you have to, if you're going to be buying marijuana stocks here, you have to really look at the business models of the companies. And I remember just a few months ago reading about, an analyst saying, companies that don't have their own supply of marijuana are really vulnerable. And I thought, no, it's the other way around. If there's a surplus of supply, you don't want to be in the growing game. And so, our view is, in this space, and we're not marijuana stock experts, but just from, looking at what we've seen on insider trends, it's the consumer product companies that have a chance of developing a brand that aren't tied to the capital required to grow, especially in Canada, in conditions that are probably not the greatest. I'm sure there's some areas in Canada that are fine for growing marijuana. I'm not a marijuana agricultural expert by any stretch of the imagination. However, just intuitively, somehow the Canadian climate and maybe climate change will change that over the years, but it doesn't strike me for the most part as being the best place in the world to grow marijuana. So let's see how things unfold. And then, of course, you've got the whole vaping cloud hanging over the industry, no pun intended. And yeah, that's a big one. Even a few months ago in the summer, we thought that there were some stocks that could do okay, that could reverse here as edibles in Canada became legal. And from what I understand, when you're talking vaping, you're talking edibles. It doesn't really make a whole lot of sense, but that's my understanding, is that it's part of that category. So that was kind of a growth opportunity, but now we're seeing governments get in and do what they do best, Jim, and that is set up regulations. So no, they haven't been very good at rolling out the marijuana retail outlets. I remember talking on your show about this around just before or shortly after legalization, is that there were a lot of risks and a lot of unknowns about how this whole system was going to work, and when the government's involved, there should be a discount applied to that business opportunity, not a premium. And of course, everybody was applying a premium to the marijuana space. At least, people who were buying back then, they were paying premiums because they were being told, time and time again through the mainstream media, for the most part, what a great growth story this is, and they kept being bombarded by all these promotions and all these CEOs, coming out there and saying what a great story it is and how transformational it is. Well, there's always a element of truth to all this, but it was just overhyped and oversold to people and over bombarded, and but the risks were ignored, and even the regulators came out and said, we've looked at like, I think it was 50 companies, or it was almost 50 companies, or and they said, basically found disclosure issues, if not with all of them, with a lot of them, with the majority of them. So, but that was all ignored. So, people are going to have to be careful here, I think, getting into the marijuana space, even at these depressed levels. But you know what? There are going to be some gems in there. There are going to be the market opportunity is still there, and the reason why it's still there is because government has been so slow in developing it. So yeah, the market opportunity is going to roll out, and maybe now we have we have a time where investors can take their time, buy some beaten up marijuana stocks, but look, you got to be very picky. And, for example, here's a stock I can talk about because it's so big, Alimentation Couche-Tard, which is in the convenience store business. Okay, well, they have tippy-toed into marijuana distribution business. Okay, so you don't think of them as a pot stock, but they have. And I'm not trying to promote this stock or anything. I don't own it, and but just trying to make a distinction between them and some of the early players in the space. Alimentation Couche-Tard was sort of a latecomer. They waited and watched, to see what was going on, and they've tippy-toed into the space based off of their experience in selling things like tobacco, which is a regulated, government-controlled substance. Okay, now Alimentation Couche-Tard, by the way, is in the Canadian Insider Index. It is so it's just one of the stocks that we do track, and now that's not going to the quarterly results of Alimentation Couche-Tard aren't going to be driven by what happens in the Canadian pot business, but if you're looking for some kind of exposure, right, to the business where it's not going to kill you, the stock's not going to, Alimentation Couche-Tard stock could fall for any number of reasons, but it's not going to fall because of, vaping problems or the like, right? It may have its own idiosyncratic problems, but, what I'm trying to say with Alimentation Couche-Tard, it has a small exposure to the pot business, but it's not going to make it or break it for the company, right? So, there are different ways to approach the sector, and I just think that you really have to take a rifle shot here, and because there will be some winners, but right now, I have to tell you, based off our screens, there's nothing that's really standing out, even in the small end of it, like small caps. That are right now yet a screaming buy. Maybe in a month, once we get closer to the end of tax loss selling, then there'll be some that pop up on the screen. But right now, it's a kind of a wait and see approach I would take with that sector and being very picky.
On the international trade front, is it bad news for U.S.-China trade talks that the U.S. Senate and the House have passed unanimously bills that support democracy in Hong Kong after the Chinese government has made it very clear they don't think outside powers should interfere whatsoever in Hong Kong?
Well, Jim, that is one big difference between Q4 2007 and Q4 2019. Back in 2007, we had the U.S. housing crisis that was just beginning to sort of unwind, but we didn't have Hong Kong, and we didn't have the Hong Kong situation, and that's a major difference, and that is a big risk. That is a very big risk because we don't know quite how it's going to play out, and it's a day-by-day thing. And look, we're recording this interview in the middle of the week. By the end of the week, there could be a whole set of new headlines, and so for anyone to be able to predict how this is going to play out, I think, is very, very difficult. And you can put your bets in how it's going to play out. I mean, a few weeks ago on this show, or a few months ago, I said I was more optimistic about a deal. And I am more optimistic than I was 6 months ago, but I'm less optimistic than I was 3 months ago, because that's just the way the news flow is going. And this bill that the Congress has passed, which I think, by the way, is a very good move by the United States on a number of fronts. And we don't have to get into that, but let's just say from a negotiating perspective, okay, there are other aspects why I think it's good, but from a negotiating perspective, it really kind of forces the Chinese out. Like, how badly do they want to make a trade deal with the U.S., and are they going to let this go? And let's just take a look at what happened with Japan and China at the Senkaku Islands in the East China Sea a few years ago, where there was a move by the Japanese government. It wasn't Shinzo Abe, it was his predecessor, to nationalize those islands. And the the Japanese government actually thought they were helping to defuse the situation because there was a Japanese nationalist who was going to try and buy the islands. Then it would have been a big mess. So the Japanese government thought, okay, we'll buy the island so we can keep things under control. Well, China did not like that, and so that situation became very tense, and ambassadors were being called. The Japanese ambassador was being called into Beijing, and vice versa for various types of altercations between the two countries in the East China Sea. And once you start calling ambassadors in, I don't know, Jim, it makes it very hard to get things done. So getting a meaningful trade deal done just became a lot tougher. And, so we'll have to see. Doesn't mean it can't be done, but it just means that if the Chinese want to get a deal done, they're going to have to overlook that bill. And we're all going to find out whether they're willing to put that aside and treat that as a separate issue, or whether that makes it harder for trade diplomacy to work. Is trade diplomacy going to be tied to human rights diplomacy? We're going to have to see, and at this point, it's too early to tell.
Ted, thank you so much for being on This Week in Money.
Jim, it was a pleasure to be back.
My guest has been Ted Dixon, CEO and co-founder of InkResearch.ca, his website, CanadianInsider.com. Coming up, Danielle Park, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle.
Thank you, Jim.
Danielle, a survey done by Sun Life found 47% of Canadians fear they'll run out of savings sometime during their retirement, maybe go into retirement without savings. How big of a problem is this?
It's a huge problem. It's systemic. It's global. Especially so, the idea of saving money for retirement is really a developed world concept. Let's face it. In most developing economies, people are, they're not in a position, they don't have the household income to set aside funds for an expected time in retirement. So that's really a concept that we have in the developed economies. But basically, we haven't funded it properly. So with all the marketing around Freedom 55 and all these ideas that have been sold to us by financial sales companies, people have been really sent down the wrong path. So their expectation is that, they can consume everything now and worry about tomorrow later. That's the first big problem, because obviously all this present consumption, and certainly if you're doing it on debt, just defers your ability to save for years and years thereafter. And so most people are not even getting out of debt. Some never get out of debt. Increasingly, people are carrying mortgages into their 60s these days, which means that they just never get that period where they are able to put away extra income. So that's a problem. The other problem, of course, as we've discussed before, is this has also gone on in pension funds where underfunding has been chronic for many years, and they've increasingly put bets on high risk securities to try and make up the deficit of savings. And so what you're seeing is the shortfalls are just compounding even after the longest expansion. And this, stock market that has gone up now for more than 10 years, even at that, we still have mounting deficits in capital pools, whether they're savings for public or private. And this is a big deal because people are counting on whatever savings they do have tends to be in these risky pots. And the problem is that the risky pots are at high risk of declining in value as we go into this next recession and bear market, which is now long overdue. And there's a lot of data that shows that if people lose money late in life, early towards retirement, either, just before or into retirement, that they never make that back. Because as I've said before, the issue is that once you start trying to withdraw funds, income from the funds to support yourself, you're really going to erode that capital very quickly if you're, one, assuming too high of a withdrawal rate, which most people are, or number two, if you lose some principal in a drawdown period, like a market downturn. And of course, we've set ourselves up for this perfectly because we've had this extended bull run where people have taken on extraordinary risk in the financial sector again. You have an S&P 500, the U.S. stock market today is trading at 2.25 times the total revenue of all the companies in that basket, just as one indicator. And 2.25 times revenue is far and beyond the most overvalued stock market we've seen on that measure ever in history. And it was at the peak in the tech wreck bubble, it was 1.77 times revenue. So we're even worse than that. At the bottom in March of 2009 when stocks had come off 50 to 70%, you had a price to sale ratio of about 0.8. And generally speaking, anything 1 and under is considered attractive value-wise. 2.25 times is considered, like manic insanity. And this is where most people are parking whatever meager savings they have today on the hopes that they'll somehow be able to catch up deficits and or take out more than safe deposits can provide. So it's that cocktail of undersaving, spending too much, carrying debt too long, and then putting whatever savings one has into these obscenely valued markets, which are very likely to implode and hurt their assets. So it's a very dangerous time.
Now, is one of the problems people don't start planning for their retirement early enough? Shouldn't you start the day you get your first full-time job?
I think that is true, but I also think that the fundamental reason that people don't get to saving is because they are always taking on debt today. It's such a popular strategy to not save and buy things, but to take on debt to buy things. And so you're constantly just trying to get yourself to even, never mind get any net equity or net value built up. And so, that is the fundamental issue. So this taking on things like 7-year car loans for depreciating assets so that you're constantly, and then people have been rolling these over with negative equity in cars. That's a disaster because you'll never get out of the hole with that. They've really been, all these sort of tantalizing offers that have been made by the lending community over the past decade, where it's sort of like, why wait? Why not have that whatever, blank, trip, car, house, whatever you want, furniture, whatever. What it means is that people get into these debt traps and they often start young, whether they're students or whether it's when they first get a job. They don't defer that gratification in terms of those purchases. They go ahead and get it on credit. And that means that they're just never getting to a point where they're actually amassing money. You really do have to get out of the hole as quickly as possible and then control your spending and have excess savings then to put aside. And it's that deferring of the present consumption that creates that future savings pool on which you can then draw when you're in retirement.
Of course, with ultra low interest rates, there's very little incentive to put your money into a savings account, is there?
Well, actually, that's completely false because what we've seen is that in countries that have negative interest rates, the consumers are actually saving more because they're realizing, my money is not growing at the rate that I hoped it would. That means I'm going to need more. So I'm going to need a larger pool of savings. So this idea that, what's in it for you for saving, what's in it for you is having financial stability, having optionality, having the ability to choose to do something other than full-time employment or change jobs and or found a business. These are the upsides that come from not getting yourself into debt, and certainly not into consumer debt, which is non-deductible and typically for consumption purposes. So this is, the issue. It's people have to understand that saving is for us. It's a gift we give ourselves. It's a gift we give our children, frankly, if they see us live with self-discipline, if they are not if they don't have to go into debt to get an education themselves because we have been able to forego some consumption and put away money for them, then they don't start in the hole. It's a generational gift. It really is. And it's also something that's learned behavior. You know, we can emulate that and people can see us living with discipline. Those are the things that are really what we should be, you know, trying to teach instead of how to teach how to borrow and get consumption.
Ontario has seen a huge surge in consumer proposals. What is that all about?
Yeah, well, so the Superintendent of Bankruptcy issues a regular report, and they are noting that Canadian insolvency filings, so this is across the country, frankly, are up 19% year over year in September, which is the fastest pace of rise since 2008. Now, the reasoning there, it's an interesting stat that we've got this spike starting. It's starting from a very low level, but it's an interesting detail because we are still in an economic expansion technically, right? We still have 5.5% unemployment, which is extremely low. So even with, again, very low interest rates, as you've said, where mortgage rates are less than 3% in many cases, and people are able to still get cars for, very, very little down and a relatively low interest rate, that sort of thing. Even then, we have this jump in insolvencies. And so that's consumer proposals and bankruptcy. So people who finally go to a trustee in bankruptcy and say, you know what, I can't make these payments. I've been juggling card to card. I've been borrowing from Paul to pay Peter. I just can't keep up. Now that the collection agencies are after me and I'm melting. So, the trustees in bankruptcy and insolvency are in a very booming business right now. They are literally seeing the busiest time they've had in more than 30 years. And so what that means is it's not just in places like Alberta, which is interesting, right? People are thinking, okay, you're talking about the downturn in the oil patch, and therefore, we certainly have seen terrible stats coming out of Alberta and Edmonton where, food bank usage is way up and people are losing their homes and all sorts of things. But this is actually also in Ontario, which is the point that many in the West miss, is that there's been a manufacturing downturn going on in Ontario for a number of years. And really where the growth has come from has been from the housing sector, which people have, borrowed to buy into and levered themselves to the highest debt levels ever. Just to try and get on the quote property ladder. So that has driven the economy in the short run, but with a great cost, right? And the cost is this 1.7% debt to 177% debt to disposable income levels, which make people extremely vulnerable. So even before they lose their job, they are having a hard time keeping up just with basic living expenses. And also, as I said, the using of all these different credit facilities and the availability of credit, which was very loose for a long time, has really led people to this difficult point. The other thing that the trustees are noting is that the surge right now is happening primarily in non-homeowners, so people who have revolving lines of credit, credit cards, they went to payday loans, all these sort of desperate moves to try and make ends meet. But the banks in Canada are already quite tightening in terms of not doing the consolidation loans that they were offering, even 5 years ago or 4 years ago, where they were, doing this, giving people new lines of credit to pay off consolidate other debts. And the trustees are saying that the people are being turned down by the banks in Canada now for this type of thing. So there's definitely tightening going on, even though the Bank of Canada has remained pat so far at, 1.75, and their next meeting is December 4th, and people are saying, they're not, Governor Polis said today in a speech that he thinks we're about right in monetary policy and we don't need to cut rates further. He's hoping, he's trying to keep some powder dry for when this downturn really gets worse. But even as I say, the strains are evident across the financial spectrum there in the households and also in businesses, which another stat that came out is the amount of, strain in the oil patch and the energy patch and the amount of debt that is having to be reorganized there. Because oil prices just have not sustained above $60 a barrel, and it's unlikely that they will. The OECD, which is the Global Institute for Economic Growth, put out a new target today. They trimmed their global growth forecast once again, Jim, now down to 2.9 for 2019 and 2020. So looking forward, they've got major economies like Germany with an estimated GDP growth of just 0.4 in 2020. So this is supposed to be one of the powerhouse economies, right? And they're in a manufacturing downturn as well. So you're seeing this with, CN layoffs, for example, in Canada. And of course, now we've got the strike of the conductors and yard workers and train workers that is happening, and that will impact other sectors. So the Canadian economy, as I say, has been going along on primarily housing, and that's a very highly levered sector now with a lot of debt there. So the other parts of the economy have been really struggling, and I think that the CN strike is not going to help that. We've got a downturn in the BC forestry industry. We've got a backup in the grains now from Saskatchewan. There's going to be less product sold. And, 90% of grain in Canada is moved by rail. So all these things, we were already very weak, late in the cycle, highly levered, as good as it could get on the low unemployment rate. And any of these factors are all going to hit us harder than they would have if we had less debt and we had higher savings.
We'll have more with Danielle Park when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Danielle Park. Danielle, has Ontario made some major changes when it comes to sustainable energy?
Yeah, so unfortunately, for the last many years, Ontario was investing in a lot of renewable energy projects to augment. We already have a high hydro component to our electricity in our grid in Ontario, and they were building lots of wind turbines and various solar plants, solar arrays, all sorts of good things that were coming. Now, of course, they take funds to build, and it takes time. And now the new Conservative government, that came in under Doug Ford, has announced that they're going to, they announced this last year that they were going to cancel some 750 different projects. And the tragedy there is, at the time, everyone was thinking, surely not, because, that would cost a ton of money to cancel things we've been building for a decade to make this transition to cheaper, cleaner energy. But indeed, they insisted that they would be able to cancel them, and they said the taxpayer wouldn't pay the price for the cancellations. Well, now we're paying in two ways, because it's now out that it's costing some $230 million to tear down these projects that have already been built, which is just the ludicrous madness. And secondly, it's going to make it that much more difficult for us to make this necessary transition to cleaner energy. So it's just the exact opposite of what leadership needs to be doing at this point, and especially to throw, more money after undoing something we've been investing in as taxpayers for the last decade. It just makes no sense whatsoever. So it's very difficult. There's a bunch of think tanks right now doing a major investigations of different economies in the world, including Canada, and looking at our energy structure and what assets need to be stranded, essentially, not developed, and what assets have to be invested in order to build out our grid for a more sustainable future. And the amount of funds that are going to be trapped in assets that can never be brought to the market are huge. So, first of all, that's a loss in terms of our present balance sheet assets that many companies and governments are factoring and assuming are going to be available, which will not be something they can actually sell going forward. And secondly, they need a lot of cash. So they're looking at how are we going to raise green bonds and various funds for investment. There's a lot of money that needs to go in up front for this stuff. So there's opportunity here. There's partnership between the private and public sector for sure. There's lots of investors that are looking for, intelligent things to do with liquidity floating in the world today. But to have governments trying to, take us back into the past and cancel the developments for the future is just completely counterproductive.
Where is the energy going to come from that would have been provided by these canceled projects?
So we have a good deal of nuclear power in Ontario. The idea is to transition, not have to build more nuclear plants, which take, billions and billions of dollars, routinely run way over budget and take 20 and 25 years to complete. So, augmenting our energy needs with more nuclear is not a very effective prospect at this point. We've already got pretty much all the hydroelectricity that we can generate. So it's just a function of, what else are they going to do other than natural gas and oil or whatever. They've already closed down most of the coal plants. So this is really just mind-boggling. I can't understand how, they could look at the math of this and think that was in any way prudent. This is supposed to be a conservative government, and this is what they're coming up with our tax dollars.
Ontario has decided to privatize its legal pot stores. For a province that has the biggest population in Canada, you have so few pot stores. Is the government finally seen they're not making much money on this?
No, I think that it's more, so you've seen, as you may well know, there's been a big washout in the cannabis sector in the past year. Valuations got really ludicrous fringe about this time last year. Everyone was sort of in a frenzy around this idea of legalizing marijuana, and they had dollar signs in their eyes, and they forgot that it was a long-term project in terms of building out supply, distribution, all the regulatory stuff around it, appetite in the public. There was a lot of things that had to be sort of worked on. It wasn't an overnight success story. And so, of course, you had a lot of production come online. You had a lot of companies canceling other even crops or things they were planning to grow to double down on the marijuana space. Now, what happened was, you get a lot of product produced, and then you have a bottleneck at the distribution level. So there's something like 24 licensed cannabis stores in operation in Ontario right now, but the revenues have really plunged on the cannabis companies, and they've been very vocal in blaming the provincial government and saying, we can't get enough distribution for our product. There's something like 69 other stores that are currently in the application process, but it takes time and it hasn't been moving through quickly. So I think this is just, New Brunswick came to a similar conclusion last week where they said, I think the province needs to get out of the business of distribution or wholesaling and just, let the private sector do that. We'll be in the regulation business, and we'll be in the tax collection business. And of course, all the provinces desperately need tax funds right now, so that makes sense. But it's they need to hand it over to the private sector so that they can work on getting the product to market.
Now, BC, they just released recently which province was making the most money on marijuana. Alberta was first. BC was second last. And again, BC has so few stores. Alberta has let it be run by private enterprise. They have hundreds. How much business are the provinces losing out, and has the black market actually profited because they can sell it for less?
I think that's probably what's at play in British Columbia, right? Because you've had a pretty healthy tradition there of using marijuana, but not necessarily through any provincial distribution network. So that's probably part of it as well. I was in Toronto last week, and walking up Yonge Street, noticed there was a whole bunch of pot storefronts, but none of them were actually officially sanctioned outlets. So I'm not exactly sure how that's working, but there's stores selling it all the way up Yonge Street that are not the actual provincially licensed outlets. So I'm sure that there are a lot of tax revenues or opportunities that are being missed out right now because they haven't been able to roll out these official distribution centers quickly enough. So I guess we'll see how the private sector handles that and whether they're able to do it at a faster pace.
I just thought it was interesting that Alberta's profiting the most, and I think they were the province that opposed legal pot the most. I guess once you have it, but they are free enterprisers.
Well, interesting. I don't know. They have financial woes right now. Maybe that makes people more inclined to use things to calm them down, or I have no idea.
Danielle, it's been a while since we've gone over. What exactly does Venable Park Investment Council Incorporated do, and what kind of clients do you have? So
we're an absolute return financial management company, which means that we manage wealth for minimum of $1 million or more per household. And it's not about we don't try and outperform a benchmark or a stock market or try and lose less than a stock market in a bear market. Our idea of progress is to have positive gains every year and to try and just compound that over time with very low volatility. And so the other thing is that we're fiduciaries, so that we don't sell products. We actually do individual work for the families that we work for, and we don't have any conflicts of interest or any mandate to get them into any kind of risk. It's all done on a very individual basis.
Danielle, thank you so much for being on This Week in Money.
Thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. She's president of Venable Park Investment Council Incorporated. Her website, jugglingdynamite.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Ted Dixon, and Danielle Park. And thank you for listening. If you have any questions for our guests or for the show, you can send them to info@howestreet.com. Now stand by for company showcase updates from American Manganese President Larry Reaugh and Cypress Development's Don Mosher. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with American Manganese CEO and President Larry Reaugh. Welcome back to the show, Larry.
Jim, it's a nice sunny day here, and I'm glad to be on the show.
Larry, you've just put out a news release. What was in it?
It was another one of the Pier 1 companies that we've been testing material for, and we had very high, not as high as the previous release, but within a couple of hundreds of the purity that we got back, and we were really happy with that, and I believe that the Pier 1 companies are happy too. And so that release went out. We've had, I would say, the majority of the steps that we've taken and the releases we have always been progressive. And the company is in a wonderful position. There's lots of interest in us. And we're getting a lot of press now, especially from just across the line in Washington. So it's been a great time for the company. Now, when we talk about the purities and everything like that, we arranged to send back the samples to the Pier 1 companies. They got booted upstairs in one case. In the other case, we're talking to the people that are decision makers, but they have to boot it around their technical group. And so I'm not sure when we will hear back on that, but, I wouldn't expect it for at least 3 weeks. So it's just another stepping stone for us. It was a time when we were getting absolutely no batteries submitting material to us. We were getting it from scrap dealers. And now it's the page has turned. Now, there's some really important news that came out. I know people have heard me talk about this predator trading that goes on in Canada, and especially on the venture exchange, which is, has very little liquidity. Now, that is going to change, and it's going to change positively for the investors. The predators have given them an opportunity to keep buying stock at very low prices. I know for the long-term holders it's been frustrating, but anybody else, any new guys or anybody wanting to beef up their position has been able to do so at, within that 20 to 24 cent range. And I think that now with what's happening in the markets with the predator trading, which I've been talking about, by the way, since for 6 years or more, and now we've got people that have more clout than I do talking about it. So there's been a movement called Save the Canadian Mining, an advocacy group created to give voice to the specific interested junior mining sector. So it's not just the junior mining sector. I want to remind everybody it's also the tech sector. Nobody's immune to predatory trading. And so the current rules in our equity markets have created an environment for predatory short-selling practices. So something's got to be done about it. Well, Save Canadian Mining is moving ahead with that. Now, they've got a lot of the regulatory organizations in Canada and Canadian securities administrators and the likes of one of the best-known financiers in the space, Eric Sprott, has come out against this short rule. And so it looks like there's a movement afoot to get the officials to recognize that this is damaging the market, because if it keeps up like this, we won't have a market in a few years. And so I'm happy to see that happening, and I just wanted to remind everybody that got tired of me hearing me talk about it for the last few years. It's a positive move forward. Now we have people that the authorities will listen to and the regulatory bodies will listen to, which will make things easier for us. So there's going to be some inclusion of that on my press release, even though I sent stuff out earlier in the week. But this is fantastic news, and I think the shareholders should embrace it, because now it's going to be a level trading floor for the investors. Before it was predators dominated the trading in Canada, and now we'll have a level playing field. So I can't see that as anything but good. So I expect to see that predator trading will start to slacken off. Nobody wants to get caught when the rule changes, and maybe we will start to benefit from the great news that we've put out. I mean, wow, we're everybody around the world's interested in this, but it seems like the Canadian markets are not allowing the company to breathe. So, hey, hats off to these guys. So, Jim, I think that I'll wish everybody a great weekend, and I know I'm going to have one, and we'll go from there.
Larry, before you go, can you maybe give us just a small thumbnail of what American Manganese is about, where people can get more information and where you're traded?
Okay. The American Manganese is a critical metal company that first got involved in technologies and manganese back in 2009, and we patented a process for taking extremely low grades of manganese and making them competitive with the world for actually producing electrolytic manganese metal and electrolytic manganese dioxide. And we actually spent a lot of money and went through the whole pre-feasibility stage and permitting and everything like that to get this project underway, and only to lose out to a sliding commodity price. And that's usually what happens when China gets involved in building these factories. They overbuild and they over-stockpile. And the next thing you know, you're looking at lower prices. You've seen this in lithium itself. So what we did is we put the project on the shelf, and Cameco CEO phoned me up and said, look, I think this will work on these cathode materials and lithium-ion batteries. So we started to work on that about 3.5 years ago. Since then, we've gotten 2 patents with a third one that will be applied for. We've advanced the project through the pilot plant stage, and we're the only transparent company out there that when they say they can do something, they announce the results of our arm's length contractor, and you can actually find out all about that on our website, AmericanManganeseInc.com, or you can phone me at 778-574-4444, or you can email me at LREAUGH@AMYMN.com. We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. And we're traded in Frankfurt under the symbol 2AM.
Larry, thanks for the update.
You're welcome, Jim.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on November 22nd.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Cypress Development Corporate Consultant Don Mosher. Welcome back to the show, Don.
Pleasure to talk to you again, Jim.
Don, what's the latest with Cypress? Some people are wondering what's happening there.
We're moving ahead with a pre-feasibility study on our Clayton Valley Claystone project. And the big issue that we've always faced in regards to this project is the fact that nobody has ever been able to put a claystone lithium project into commercial operation, where they're actually complete the mine and are producing lithium hydroxide. So we've been working on this project for about 3 years. With my experience in the mining world, it's moved along very quickly. We've basically gone from a grassroots situation where we were originally looking for brines in Clayton Valley, similar to Abermarley's production facility there that's been operating evaporation ponds for over 50 years, to taking a look at the clays at surface and realizing that they have a lithium content. Moving forward with that, finding out that these claystones are actually leachable in comparison to Western Lithium to the north of us on an old Chevron project having claystones with higher lithium content, but it was refractory. So the issue they had, and they spent like $40 million working through metallurgical issues up there, was it was refractory. You had to mine it, you had to put it into an oven, cook it into a brick, break the bricks up, and then you could leach the lithium out. Our clays are easily leached. So then we move forward from there with drilling, realized that we had a massive resource flat lying, very little overburden on it, and with some drilling decided to focus on one specific area of it. So we drilled out about 300 million tons, which would be about a 40-year mine life. We put out a preliminary economic assessment on it. It had a a net present value of $1.4 billion U.S. based on what the contained lithium was in the clay stones, and now we've moved forward into a pre-feasibility situation. So we moved into a pre-feasibility situation on this. We've been working on the pre-feasibility since early spring. We had anticipated getting it out sometime in the fall, but now we're into November, and what we've decided to do was call it a mini pilot plant situation where we've gone into an engineering firm called NORAM here in Vancouver, and we're going to complete the final process on the flow chart. We're very happy with digging up the clay, putting the clay into a leach situation, pulling out the solids, ending up with a solution. And really now what we're focused on is taking that solution and producing a commercial grade of lithium hydroxide and potentially some rare earths to go along with this. So what we're doing is building credibility for the entire process that you would see once the mine is built. Digging it up, working through the leaching situation on it, removing the solids, which is very difficult. I mean, that was one of the biggest barriers for our CEO, Bill Willoughby, was, you know how sticky clay is. I don't know anybody that's got experience in, I grew up in Saskatchewan, and I mean, that clay there sticks to everything. So even when you do get the clay into solution and you're pulling the lithium out of it, how do you get the solids out of the solution and get it to a point where you can put it through a membrane technology and go through that extraction process? We ended up taking a look at some commercial applications that they used in the potassium industry, some screening, and we've managed to remove most of the solids out of solution. So now we're on the very back end of that flow chart, and we want to put it into a mini pilot plant. Normally you would just see the pilot plant come in when you're doing the feasibility. We'll have a pre-feasibility that encompasses everything from start to finish, producing lithium hydroxide. And anybody will be able to repeat this process, and it should build huge credibility for what we're doing.
Where is all this action taking place?
It's taken place in the U.S., in Clayton Valley in Nevada. And you couldn't have a better jurisdiction for an operation like this. Right now, there's huge disruptions in the Atacama Desert, with both Bolivia and Chile dealing with a lot of civil disruption. On Monday, there was thousands and thousands of people demonstrating in every major city in Chile, and this is also occurring up in the Atacama Desert, because the lithium production up there was originally for potash, and they had a byproduct of lithium, and they have now become the largest producers of lithium in the world. And it's a very cheap form of producing lithium, because you're just pulling brines out of the ground and putting them into evaporation ponds and allowing the wind to concentrate everything down. But there's always a cost, and in this situation, the cost is you're drawing down all the aquifers. So now the locals are getting very upset about the threat to the aquifers up there, and as a result of that, I think you're going to see a threat to global lithium supplies.
Where are you traded, and how can people get more information about Cypress development?
We were traded on the Venture Exchange on the TSX. Our trading symbol is CYP, and they can get all the information they need at cypressdevelopmentcorp.com.
Don, thank you so much for the update.
Thank you very much, Jim.
We've been speaking with Don Mosher. He's the corporate consultant for Cypress Development. I'm Jim Goddard. Our conversation took place on November 19th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Company Showcase is a production of House Street Media Incorporated.